Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of the corporate world. And today we're looking at a company that's trying to stay in the game by selling more pieces of itself. Alright folks, we're diving into an 8K filing from Inspire Veterinary Partners Inc. Now an 8K is like a company's real-time diary reporting big events that happen between their regular financial check-ins, and this one is all about keeping their stock listed on a major exchange, the Nasdaq Capital Market. The date on this report is August 2025, and it's telling us about some pretty crucial moves they've made. So Inspire Veterinary Partners Inc., you know them for their vet clinics, got a little warning from Nasdaq. The problem, they weren't meeting the minimum stockholders' equity requirement. Think of stockholders' equity as the net worth of the company belonging to the owners, the shareholders. If this number drops too low, Nasdaq, which is like the bouncer for the stock market, says, hey, you're not valuable enough to be on our VIP list anymore. And that's exactly what happened. Back in April, Nasdaq sent them a notice saying their stockholders' equity, which was reported as 1,000 to 62,005 in their annual report, was too low for the Nasdaq capital market. This is a big deal because being on Nasdaq gives a company more visibility and makes it easier for investors to buy and sell their stock. Now, companies usually have a grace period about 45 days to come up with a plan to fix this. Inspire Veterinary Partners submitted their plan on May 23rd, but plans are one thing, execution is another. So how do you boost your stockholders' equity quickly? You get more money into the company. On July 28th, they announced a private placement. This is where they sell a chunk of stock, in this case Series B convertible preferred stock, and some warrants, which are like options to buy more stock later, to specific investors, often big institutional ones who qualify as accredited. They were aiming to raise up to $10 million in this deal, and they didn't waste time. The very next day, July 29th, they closed the first part of this deal, bringing in about $5 million. They issued over 6,300 shares of this preferred stock and a whopping 6.3 million warrants. This money is crucial because it directly increases their stockholders' equity. They got this money not just through cash, but also by accepting transfers of other securities, which for accounting purposes is like getting cash. And here's the good news for Inspire Veterinary Partners. They believe that this $5 million injection, which happened very recently before this report, should be enough to bring them back into compliance with Nasdaq's minimum stockholders' equity rule. But here's where the tension remains. Nasdaq isn't just going to forget about them. They'll be keeping a close eye on the company's next financial report. If they dip below that equity requirement again, Nasdaq could still delist them. So while they've dodged a bullet for now, the fight to stay listed is ongoing. It's like getting a reprieve, not a full pardon. And who signed off on this important news? None other than Kimball Carr, the president and chief executive officer. He's signaling that the company's leadership believes they've navigated this critical hurdle. Now, let's look at this from a broader perspective, a bit like Warren Buffett would. Inspire Veterinary Partners is in the business of animal health. It's a growing market as people treat their pets more like family. However, being listed on a major exchange like Nasdaq isn't just a formality. It's a lifeline for growth, allowing access to capital for expansion, acquisitions, or research. When a company struggles to meet listing requirements, it often signals underlying financial instability or a business model that isn't generating enough retained earnings. The fact that they had to tap investors for a private placement issuing a significant number of warrants is a double-edged sword. On one hand, it shows they can attract investment and have a plan to address their equity shortfall. On the other hand, the high number of warrants means a lot of future dilution for existing shareholders if those warrants are exercised. This can significantly reduce the ownership stake of current investors and potentially depress the stock price. They raised $5 million, which seems like a lot, but for a company that needs to maintain a certain equity level on Nasdaq, it's just enough to get them over the line for now. The real question is, will this be a sustainable fix, or is this just a temporary band-aid? Their ability to generate profits and increase retained earnings in the future will be key. If their core business operations don't improve significantly, they could find themselves in this pickle again. It's a stark reminder that financial health isn't just about meeting rule-based requirements, but about building a truly robust and profitable business. They've bought themselves some time, but the real test is in the coming quarters and years. Can they grow their earnings and equity organically, or will they need more of these dilutive private placements? The veterinary market is competitive, and Inspire has to prove it can thrive. Not just survive in this environment and is competitive. And Inspire has to prove it can thrive, not just survive in this environment. Alright, that's our breakdown of Inspire Veterinary Partners' latest move. What's your take on these numbers and what they signal for the company's future? Do you think this private placement is a good sign or a worrying one? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.